Welcome back to Blocks for Jocks. My name is Alex Feinberg, and this is episode 2. What's wrong with money today? Our present financial system seems to work. Sure, some people are very rich and some people are very poor, but isn't this just the nature of supply and demand? When I use money, people always take it. When I go to the bank, my money's always there. So what's the problem, you might ask? Today, as you know, we don't use precious metals as money, so our money creators are not actually gold or silver miners. They go by a different name on the street. We call them bankers. Yes, the place where you deposit money is actually the money factory that creates the foundation for our economy. Unlike gold and silver miners, who used to basically create money when they dug it up from the ground, bankers actually create money when they loan it to you. If you qualify for a loan, the bank is actually legally allowed to write a couple entries in their books that say, Joey has $100 in account 123 and is expected to pay us back $104 by the end of the year. Okay, so what's wrong with that? Joey buys a house or starts a business, it goes up in value, and obviously he can pay the bank their money back, so it works, right? Well, sort of. This arrangement works at the bank to customer level, but when every bank does this, something weird happens. Prices actually start to change because of all the new money that the banks created and lent out to their customers, because the customers took the money that they borrowed and then spent it on goodies like houses and businesses. Hold on, you might think, why would prices change? Prices change because when the banks loan out money to new home buyers or buyers of anything like businesses, they enable new buyers to enter a market. When a new buyer enters any market faster than the supply increases, the growth in demand will push prices up. This relationship between buyers and sellers is also referred to as the market. Okay, you might think, so prices change, but what's the big deal? It seems like everybody's better off, right? Houses and businesses are gaining value and lots of economic activity is enabled, so aren't we all winning? Sort of. But it's more like everyone is better off temporarily. When this happens, the economy feels like it's booming. Banks are lending out a lot of money to a lot of homeowners and businesses, and bankers are collecting big bonuses because the more loans they create, the more profits they can claim they were responsible for. You should note that usually banks book the profits of a loan soon after they issue it, even though the loan will get paid back over time because the banks actually sell the ownership right to the borrower's IOU to somebody else shortly after they issue the loan. Businesses are happy because they can borrow money and start new projects, and employees are happy because everybody's hiring. This seems great, so you might think, what's the problem again? The problem is when the institutions that continue to loan our government money realize that everything within our economy is increasing in price at a rapid rate, like inflation due to the inflated amount of dollars in circulation, they will not be willing to lend money to the government as readily. Why would I lend Uncle Sam $100 today to get paid back $103 next year if I would be better off using my $100 to buy something today before the price goes up to $105 next year? When prices start increasing, the interest rate the government has to borrow at goes up because investors will realize that the $103 they get paid back will be worth less than the $100 they lent out today. Investors will start to demand $104 or $105 in interest. Okay, you might think, so the government pays more in interest, but what's the big deal? Remember that bankers work in a competitive industry. They're only lending you money because they can't find a better or more profitable use of it. And if a bank can now lend the government $100 and get $105 back, they would never loan you $100 for anything less than $105 because you as an individual or business have a much higher risk of defaulting than the federal government does. Because unlike the federal government, you can't make laws to give yourself more money. Sorry to tell you that. Okay, so I need to pay a higher interest rate on my loan. So what, like 1% or 2%? I can take care of it. Well, maybe you can. But across the country as a whole, some people cannot. So what this means is that some buyers who could only have entered the market thanks to low interest rates can no longer be buyers. But the inventory of available goods is still roughly the same and possibly increasing if businesses had planned for continued growth of buyers. So the cycle turns, and exactly the opposite of what happened at the beginning of the cycle occurs. Prices start to come down, and this is called deflation, and it follows a deflated money supply. And then all of a sudden, the value of some of the IOUs that the banks hold from borrowers, but have not yet sold off begin to be questioned. Everybody knows that many loans to the lowest credit borrowers won't get paid back, and more importantly, the houses or businesses that these borrowers mortgaged to receive their loans in the first place continue to go down in price because higher interest rates mean fewer people can take out a loan to become eligible buyers to bid for the property. Remember, supply and demand never stops being relevant. So this creates an interesting dynamic. If the borrowers stop making interest payments, the banks might need to foreclose on the houses or cars or businesses that were used as loan collateral. But the price of the underlying asset could have dropped so much due to fewer buyers being around that the banks can't actually sell the underlying asset for the amount they loaned to the buyer. So they foreclose on the property and sell it at a lower price. But it doesn't stop there. See, when the banks foreclose on it and sell it at a lower price, all of a sudden the houses or comparable assets that other borrowers have put up to receive their loans have a new lower benchmark to be compared to. So the price people will likely pay for their assets has also fallen. This means that people who may be able to afford to pay their bank back might opportunistically choose not to, because it would be cheaper to buy the property outright at the current market price than to pay the bank back what they owe. So what happens next? The banks will eventually need to admit that they took a loss on their loan and write them down against their annual profits. Okay, you might think, that seems fine. Bankers can survive on a little less money, right? Well, they can certainly survive on a little less. But if all, or at least a big chunk of their IOUs start to have this feature, then what happens is the amount of money that all the banks owe to all the people who have lent them money, like their customers or people with checkings and savings accounts, if that exceeds the amount that they will likely be paid back from their borrowers through these IOUs, they'll owe more total money than they can expect to receive. In this situation, customers and financial analysts will start to panic as they come to fear that the bank that they themselves have lent money to does not have a sufficient quantity or quality of customer IOUs to receive the money necessary to pay them back. So they withdraw their money from their account, lowering the amount of cash the bank has on hand. When the bank has less cash on hand, it's not allowed to make as many customer loans and might actually have to stop making them. And when many banks are all in the same boat, the supply of available new money through loans will continue to drop, which will push prices further down, causing this feedback loop to repeat. As prices fall, more borrowers realize that they owe the bank more than the underlying asset is now selling for, and many more will default on their promise to pay the loan back because they too realize that it would frankly be cheaper to just start over and try to buy the asset at the current market price than to pay the bank back what they borrowed, say, a year or two ago based on the price of the asset a year or two ago. This situation might seem crazy, right? You might think, has this ever happened on a massive scale? You might know that people talked about this as a possibility, and you might have read something similar about this in 2008, but why should you be concerned about this now? It's never happened as badly as I'm describing it, and there's so many things to be scared of. So why might you concern yourself with this or any sort of financial collapse that's never happened when there's a lunatic in North Korea pointing nuclear missiles at us and parts of the country are constantly on fire and flooding? Certainly there's better things to keep you up at night, you might think. Well, the reason a collapse hasn't happened is due to the precautions that our king money creator, our master bank, also known as the Federal Reserve, takes to ensure this situation doesn't happen. They'll do whatever it takes to ensure the feedback loop of declining prices never gains momentum to get going. That seems pretty smart, right? These guys, they all went to Ivy League schools for a reason, right? You might not want to see crashing prices if it's going to make the economy grind to a halt, and you might be happy that someone smarter than us is making sure it doesn't happen. But this is the fatal flaw of the system. The only way to avoid downward spiraling prices grinding the economy to a halt, at least eventually, during an economic downturn is to ensure that more and more money is created over time so that the lenders, bankers, don't go broke and can continue creating more and more money. So who wins, you might ask? Bankers, because they as a class will have to make profits over the long run or the whole system will collapse. They've literally designed a system that will not work if they don't profit over time, and no other industry works like this.